But at the same time, I kind of understood the power of compounding, because by the time I was 12, I'd saved $1,000, and I got a check for $10 a month. You know, back then they still sent it to you, but I was hooked. I was like, man, this is really good. And I started reading about compounding and interest and investing early. And I read all those things back then as a kid, because my dad's finances were always up and down. So I always told myself, don't end up like Dad. I just didn't want to have feast or famine. And then as I was in high school, 1985, you all remember that movie Top Gun that came out? Well, I was hooked. I just loved that movie. I loved other movies like An Officer and a Gentleman. And since I always wanted to fly, I was so grateful to be here in the U.S. that I wanted to kind of give back and serve. And my way of doing that was to join the military. And I went to the Naval Academy. Was lucky enough to get a nomination and served 4 years at Annapolis. Real tough training, but fantastic people. And then I went to flight school down in Pensacola in Texas, and got my education flying Navy jets. And I did that for 7 years after you get your wings. So I had a commitment of about 9 years. So I flew jets all over the world with some of the best guys. And then afterwards I went to instruct back in flight school. And had nothing to do with real estate at that point because I was too busy. And then in 1999, I was done with my Navy commitment, and then I always wanted to go to the airlines because all my mentors were airline pilots and they were making great money and life was good. So that's what I did. I got hired at United Airlines, and I was flying here out of SFO on the 737. And life was really good. Was married, and I had a kid, and life couldn't have been better. I only needed one paycheck, a W-2 that was really good. And then 9/11 happened, and it was a shock. It was a shock to everyone, but for airline pilots especially. You know, Jason Dahl was one of the guys I knew. He, perished in the attacks on the World Trade Center, and it was personal. So having lost my dream job because of 9/11, I scrambled. I lived your typical American life, you know, big mortgage. We were overextended, and suddenly to have no paycheck come in because United let 2,500 pilots go right away. I really told myself, man, you've got to do something that you don't ever rely on a W-2 again. And but I had other problems. You know, I was going through difficulty in marriage, and it was a really tough time. I had to take a job at Pfizer selling pharmaceuticals, put on a suit and tie every day, and needless to say, going from a flight suit and a uniform to putting that on and getting shooed out of doctor's offices, it was very humbling. It was really, really hard. But I made the best of it. I lasted about a year, but during that year, I applied to get back in the military. And it took a long time. But I did. I finally got accepted to go fly C-5s in the Air Force. And I crossed commission, meaning I kept my rank and my seniority. And that's when the war in Afghanistan and Iraq started. So I went from, selling pharmaceuticals to flying combat missions in Afghanistan and Iraq every month. I was gone 2 weeks a month. But they were good memories. I really, really enjoyed it. Long story short, by 2005, I was divorced and single, and I met Jennifer. She works at Intel, and it was a really good second start. So life was good again. And I said, I've got to find a nice house. I'm hardly ever around. I'm gone all the time. So where do I really want to live when I have free time? And that was, for me, Lake Tahoe. I just loved it. And I especially loved the Nevada side because in the military, you can live wherever you want, and that's where you get your tax benefits from. So I found myself a really pretty house in Tahoe on the Nevada side of the lake, which overlooked the lake and also overlooked the Carson Valley. Those of you that are familiar with the Heavenly Stagecoach ski lift, that's where my first place was. And it was really funny because I bought it just as a residence. And it was a $300,000 3-bedroom, 2-bath. And but I was gone a lot. So what I did is I said to myself, hey, wait a minute, people want to come up here all the time. Why don't I rent it out when I'm not here? And back then, VRBO was a really crude website, and Craigslist was still very dominant. So I put it on Craigslist, and Craigslist didn't have any scammers back then. It was really legit. And I had people coming in all the time whenever I was gone. It was really efficient. In that first year, and every year after, it always grossed about $50,000 to $55,000. And I was like, well, this is going to be easy. I'll pay this sucker off in 5 to 6 years. And that's exactly what I did. And Jennifer bought one. We weren't married yet, but she bought one across the road. And then we just kept buying more and more. The first 3 we bought with mortgages, and after that, we just started buying them in cash because there was so much income coming in from vacation rentals. So vacation rentals, I'll say this, they are a terrific way to make money. And I'll, if Daniel has the slides, he can put it up. But for those of you that want to write down a couple bullets, my return on investment, my cap rate on vacation rentals was always hovering around 18%. Okay, so I'll say that you make that $50,000 to $55,000 a year on a $300,000 home, and that's still roughly what the prices are up there. So it hasn't changed that much. But it is a ton of work. You're answering emails all the time. It's gotten a little easier because of Airbnb and VRBO have become more dominant, and almost everything automatically gets processed through with credit cards. You don't have to send key codes anymore. So it is, it's a fine business. I encourage anyone that wants to get a vacation home somewhere to do it and to try it. And you will see that it pays really well. But there are a couple things I want to warn you about, and I just want to be real honest about it. You've got to have a really strong constitution. You've got to be able to deal with phone calls in the middle of the night. You've got to deal with angry customers. About 10% of them were just dissatisfied with everything, whether the snow hadn't been cleared from the stairs, and why I didn't have the right coffee filters in the house. So you had to just grin it and bear it. And Jennifer and I, when we first started this, we went out to a bed and breakfast, and some innkeeper told us, most people in the vacation rental business last 10 years. Or bed and breakfast for that matter. And that's exactly what it was. 10 years later, by 2015, we were done. Now, by that time, we had 6 of them together, and they were all on the same road. And the reason I did that is when you have a winner, I always tell people, don't change anything. Don't go buy a place in Incline Village, then in Tahoe City, then somewhere else, because you'll drive yourself crazy driving around. We just got them all on the same street because we knew if this is a winner, the other ones will be too. The concept of scaling, it's really simple. So on the slide, you can see the cap rate. That slide keeps coming in and out. So you can manage it yourself, or you can go and give it to somebody. I always encourage people to do things yourself first. If you absolutely can't do it, then give it to a management agency, because every time somebody else does work for you, not only will you cut into your profits big time, but you cut into control. You'll have somebody renting it out for the wrong price, or somebody that's indifferent, somebody that will offer 2 days over New Year's when you would have never given it for that short a time. You obviously hold out for 5 or 7 days. So by doing it yourself, you maintain control. You also make a lot more money. And the nice thing is you have the home obviously for yourself when you want it. But again, I will tell you this, and I'll just caution you on one thing. On vacation rentals, you'll find whenever you go visit that house, most likely you'll be going to Home Depot or Lowe's all the time instead of skiing or hiking, because there's always stuff to fix. Now, the guests are pretty darn nice, and they treat the home really well, because as opposed to long-term renters that on cheap homes, they're just not rough on things. So because I could tell from the email addresses, most of these guys worked for high-tech companies and they were really established, really good people. So damages and all that were very rare. But typical use, dishwashers and laundry machines and hot water heaters were just having to be replaced a lot. So that was a big con. Towards the end, we just didn't even like going up to Tahoe anymore because all we were doing is working. Now, when we did try to give it to a lot of handymen, and some did okay, but for the most part, again, you lose control, you get overcharged, and it just never turns out to be as good as if you had done it yourself. So what we did is in 2015, we said, you know what, we've done 10 years, we've made a ton of money on this. Why don't we go ahead and go into long-term rentals? Just like, Daniel always talks about your and what most of you are interested in, your typical get your 3-bedroom, 2-bath home, and you don't have to deal with such an intense workload. And it's exactly what is true. It is less work. It is also quite a bit less on the ROI. And I'll tell you, the return on investment or cap rate on long-term rentals, Daniel, if you can switch me to now the long-term slide, is way less than half of that, okay? Here's a typical house I bought in Folsom, California. I've got a couple there with Jennifer, and then also in Eldorado Hills. And, you can still pick these up for about $250,000, and they do well, but the cap rate's around 6-7%. Now, the game is in California. Obviously, the cap rate's so low because house prices are high. You're not really getting it just for the income. We're just all banking that the prices will continue to rise. And generally they do. Jennifer's house in Eldorado Hills that she bought in 2000, is worth $600 now. So even though we get $2,400 a month in rent in that, which is fine, but wouldn't be a great investment, the $400,000 in appreciation has been pretty good, and that's typical. We also have a home in Austin, Texas, for example, which is just the opposite. The cap rate's quite a bit higher, but again, it's far away. The reason we bought most of ours locally is because I wanted to check up on them. I wanted to make sure that if there was something truly wrong, I wouldn't lose control. I wouldn't get overcharged. There's one thing that really bugged me, and that was to get ripped off. And so, again, I will tell all of you that want to get into owning long-term rentals, you don't fall into this trap of listening to people that say, oh, I don't want to deal with tenants, toilets, and trash. You're going to deal with them. Unless you absolutely want to make no money, you can't outsource this stuff to management agencies, because management agencies will still call you. They will still tell you what was wrong, so you'll still have a sleepless night. But you'll really get a kicker when they tell you something, a couple roof tiles, were $800 to replace, and you know exactly that would have been a $48 job had you gone to Home Depot and popped them on there the right way. So it'll aggravate you less if you first do it yourself. And if you absolutely hate that, then by all means, go to a management agency. So to summarize, on the long-term rentals, California cap rate, I'm sorry, the slide says 4.5% in California. Yeah, it's probably around 5%. And the Texas, a little more, 7%, but that's because the taxes are so high. The golden rule in long-term rentals, and Daniel will agree with me on this, is the 1% rule. Whenever you buy a house to rent, you should ideally get 1% of the sales price in rent. So in Austin, Texas, you can pick up outside of town, 3-bedroom, 2-bath homes for about $160,000. You should be able to charge about $1,590 in rent. So again, that's right there. $1,600 is ideal, but you'll get close to it. The problem is you have to have a management agency there because it's that far away. You just don't have the resources to go check on it. And then you also have high tax rates. The property taxes in Austin are close to 3%. So on that home, you're going to pay $5,000 and change in property taxes. So you're talking about 3.5 months of rent gets chopped off right away just to pay for property taxes. So there's pros and cons. In general, I'd encourage you to first get your first one close by so you can keep an eye on it. In California, obviously, that's tough. It means probably having to get it out maybe an hour or two away, but really it's not tough. When you think about the times you turn over, ideally, I'll say this too, whenever you do a long-term rental, you'll screen the people yourself. It is so easy, and you'll actually do a better job than a management agency because when the people come to your open house, you'll have 20 or 30 every time you have an open house. You'll get all their info, and you'll the top 4 or 5 people that you like, you're going to run their credit and a background check. It's all done online. It sends them an email. I use rentscreener.com. They fill it out. It tells me exactly what their history is, criminal history, and also what their credit score is, how they rank from A to F, based on how they've paid before. Well, we have 9 long-term rentals here now in the local area, and we've never had a late check, ever, because all the people we've only put in at 780 credit score or higher. So it saves you a huge amount of headaches when you do it yourself. My parents, for example, have a rental, and they always had a management agency put it in, which wanted to fill it, and they'd fill it with people that had a, credit scores in the 600s or low 700s, and they had just the opposite problem. Always people that didn't pay that they had to get rid of. So this is a big plus. Also, do consider that you have HOA fees and all that stuff, and all you all understand that. But I encourage you to try that. Long-term rentals are terrific. They're not going to be as much bang for the buck as you have on vacation rentals. And then you also obviously don't have a nice place to go to when you're going on vacation. So I would encourage you to try either of those. They're great options. Now, the third option, Daniel, if you can queue up the syndication deal. I'll tell you about syndication. Syndication, as Daniel mentioned before in his talk, is essentially private equity offerings. I wish I'd known about this much earlier, because I would have saved myself a lot of headaches. But that said, I still enjoyed the headaches. Jennifer and I, we built a tremendous amount of wealth and paid all these properties off, and it wouldn't have been as fun now to invest in private equity had we not done that. So there is something to be said for putting sweat equity into things and saying, man, we did that. Yeah, it wasn't fun, and there's days it really sucked, but we did it. And so I got into angel investing here in the Bay Area 5 years ago, and more companies pitched to us. And this, for example, is a project summary that would be pitched to us. We'd have high-tech or biotech companies, medical devices pitched to us, just like in a Shark Tank. Well, the real estate guys do the same thing. They'll come and they'll say, hey, we've got a project where we're building, this one, for example, is a unit in 17 single-family homes in LA that they're building on a lot, because everything now is going into this tight housing. And they'd make an offering. They say, we need to raise $3 million because it's they're going to get a $9 million construction loan. They own the land outright already, and the permits are ready to issue. It's fully entitled. It's ready to go. So they've put a decent amount of money in, about close to $1.5 million into this whole project already. So the owners, the sponsors of it, have skin in the game. Now what they do is they'll make an offering, and they'll give a term sheet. Daniel, if you can slide me up just a couple slides here, and I'll try to talk about each slide as you go. This is the company. WJK, here's your legal disclaimer, is, for example, Orange County's fastest growing real estate developer and builder. And they offer this to everyday people like you and I. There's minimums usually are around $100,000. You have to be an accredited investor, which means, you have to meet certain income thresholds, which pretty much most people at Intel are going to meet. And you've got to just be fully aware that it's an investment, and whenever people sell you an investment, you've got to do your own research. But track record goes a long way. So, for example, here you can see that these guys are offering to build these 17 homes, and they're going to be 1,947 to 2,100 square feet each. They're going to sell each of these in pro forma, is what they put out as their due diligence, and they will sell each of these for $950,000 a piece. So they're anticipating being done with this whole project in 2 years, and selling the whole thing for about $15 million, which means they would return, based on their estimates, Daniel, up one or more pages to get to the term sheet. They will then offer to return equity right here, for example. This is a summary just on what we're talking about. 24-month deal. Okay, their loan to value, what they're getting in terms of how much leverage there is on it, and how much the sponsor's contributing, where your money will go, and then what comes out of the deal at the end. So in any Shark Tank or pitch, you got to always get to the page like, okay, what are the terms? What are you guys going to offer me if I give you money for 2 years? And there should be a term sheet, Daniel, 1 or 2 pages down, and you'll see, for example, that they'll tell you, okay, you have 2 ways to invest in this. Here's comps. The next couple pages just show you that all these neighborhoods here in LA, for example, are putting this densely packed homes that people really like because professionals, young doctors, lawyers want to have their own home, even though it's only 6 inches apart from the next one. It's not condo living, so it's a lot more desirable. And these are all the budgetary things that they've put into the deal. 1 or 2 more slides, Daniel, and then I promise I'll leave you alone. Skype was giving me a hard time on this. Here's their financial performance based on, this is a good slide here. This is pro forma. This shows you, for example, and I'll send any of you guys a sheet like this to see. And I'll tell you just personal disclosure, the builder approached me to sit on this project because he's so busy. He said, Larry, you've been a prolific real estate investor. Why don't you go ahead and raise the capital for this? And he's giving me an equity stake. So I get like a 1% equity stake, which is kind of silly because for me, I enjoy making people happy. I enjoy the mind share of the whole thing. And I'm putting personally $250,000 into this. So, or I will do more as much as my highest investor that I know. So I don't want anyone to ever think that I'm hawking something or I'm getting into a deal, because I'm not. I'm trying to share a great opportunity and share the headaches. If you go to the next page or 2, Daniel, it should show the terms. How would you invest in something like this? They'll give you the 2 options. You can, for example, here we go, option 1 and option 2. So what they're offering to do for a 2-year term, they'll just pay you 14% annualized return. It's called a preferred equity return, meaning that before other guys after the bank construction loan gets paid out, you'll get 14% of your investment. So let's say you do $100,000. You should, at the end of 24 months, have about $130,000. It's not bad in this environment. If you're worried about the market, or you say, hey, I've got a lot in my 401k, let me balance that out. I don't have enough money, and I don't want to deal with the time of purchasing a home somewhere and getting a cap rate of 4 to 5% and dealing with all those headaches. Knowing what I know now, when I was 30, I would have jumped on this and I would have never gotten my hands dirty. Yeah, I would have felt sort of like a silver spoon kid, but it is just really easy. And one thing about these builders and sponsors in general, you'll want to look at their performance. How long have they been doing it? And then look at their last 25, 30 projects. And I'll show you that in a second. But the option here, 14% annual return. Not bad in this age. Or you can choose to be a participating equity holder. And here, for example, they would simply project that, hey, at 24 months, we should have a 33.5% return on investment. Now, I've been following this project so closely that this is a really conservative estimate, because everything they're basing this on is selling these homes for $461 per square foot. That's what was in the pro forma, right, when they drew this up 6 months ago. Well, every week I check the closing numbers for similar comps in that LA Pasadena area. And the homes 2 weeks ago were closing for $559 per square foot. And it's the craziest thing. But yesterday I checked closing numbers, and there were several units that sold for $1.4 million for these 2,000 square foot, close to $629 plus per square foot. So based on those numbers, the ROI, if you did the equity option, I think it's going to be closer to 50%. It's a hot market, and the reason it's hot is for all the strange reasons. You know, COVID has not put a damper on single-family homes. If anything, you saw, and there's an article in the Wall Street Journal yesterday, a lot of people are leaving condos, densely packed homes, because they want to have their own place. So I'm bullish on the market, not because I'm always invested in it, but I think the numbers long term are really solid. More and more people just want to have their own home. So to wrap it up before I take questions, I talked about vacation rentals. Good money, really good money, fun place to visit until you start fixing everything. You're going to last 10 years. There's a lot of good and bad about it. Long-term rental, kind of easy, a little more, what I'd say is consistent returns, but not great returns. In this environment, especially if you're going to buy something close by that you want to keep an eye on, you're going to be satisfied with a 4 to 5% cap rate. Or option 3 is doing this private equity deal like this. And usually the minimum is 50 to 100,000. The sponsor will always negotiate. On this deal, we're about halfway through, so we've raised about $1.5 million. In the next month or two, we should have the rest, and then we're done, and we start breaking ground on it. But knowing what I know now, and after all the time flying in the military, I just wish I had known about this earlier. I encourage you all to look into it. Daniel also works with sponsors and has great private equity offerings. So it's funny that we discovered this pearl late, but it's there and it's easy. And the only work you have here is you get a K-1 sent to you when tax filing season comes around. You have no liability. You're not worried about getting sued or anything like that because it's a limited partnership. You are there just simply to provide equity. With that, thank you guys. Let's hear some questions. Ask me anything you want, please. If you want to hear war stories, I'm more than happy to tell you, but I'll probably tell you that if you give me a call.
What is the qualification for being accredited investor here? I know it's different for every project.
Yeah, I think it is Daniel, 250,000.
Let me ring in on that really quickly. It's actually for a single person, it's $200,000 of income for at least 2 years. And then for a couple, $300,000 of income per year for at least 2 years. Or another qualification is that if you have a net worth of $1 million, not including your primary residence. And that's how the IRS treats it, accredited investor.
So this is all of all those three, right?
No. It's or one. Either you meet the income criteria or the net worth criteria. Either one qualifies you to be an accredited investor.
Okay. And income counts the 401k? No, right? It's just your paycheck, correct?
Income counts everything that you would put down to the IRS as income.
Okay, I can sync up with you offline. It's still not clear. Okay, thanks. And also another question is, say if market tanks in next 1-2 years with the COVID and all these things going on, people losing the job, how this investment affects the option 3, which is syndication?
Okay, good question. On that PowerPoint, the sponsor there also figured out that, hey, worst case, if we don't get this minimum $461 a square foot, I believe it was a couple pages up there. What they'll do is they'll just change the model from selling. It's in the bottom left corner right there. Just up a couple, right? It's in the bottom left corner of, I think, the sheet. Up one page, right there, for rent model. You see that? So these 17 units, worst case, if they don't get the sales price where they're in the money on it, they'll simply switch the whole model and say, guys, the market is not where we want it to be. They can get $5,000 a month for these $1 million homes easily. So they've gotten the numbers. There's their annual rent potential, 25% expense/vacancy. There's their operating income, the debt they have to service on it. After that, the net cash flow. And again, here's your worst case parachute scenario. If they can't sell these units at the price they want, they'll simply get a return on equity of 13% until the market has stabilized again where they will sell it at a profit. It's been done before, and this isn't highly leveraged, so it's a very good deal because they're about 70% They're not playing any games where they're 90% or no money down, and then the bank calls it. They've got enough equity in it. So I thought I was asking the same question, and here's the answer: 13%. I'd say to myself, I can live with that until things stabilize. Did that answer your question?
Yes, thanks.
So how did you get to this kind of deal? You have to work to a company or?
Yeah, so what you would do is, normally it's these sponsors will present to investor groups at investor dinners. Like I belong to Keiretsu Forum. It's the biggest angel investor network in the country, and we meet in the East Bay in San Francisco and in the South Bay. The problem is they charge you $3,000 a year just to attend. So yeah, there's gates to keep just Joe public out in general. But if you do research, you can find stuff. If you Google private equity placements, there will be stuff. They generally they don't make it easy to find, and I've always wondered why, because I've always thought, hey, if your minimum to invest is 50 or 100,000, why are you guys not doing more of this to the public? But I have a feeling is for $50 or $100,000, it's just not worth it to them because of the separate filing and paperwork. They'd much rather just get, in an ideal situation, you'd get 6 investors that put up $500,000 on this deal and they're done. But I don't think that's fair either, because it's like, guys, come on, it shouldn't just be shared by fat cats. Everyone should be on the same terms. And certain sponsors like this will say, normally it'd be 100,000, but he's saying that's fine. If somebody just wants to do 50, if you can bundle a couple 50, we'll do that.
I was going to add here too that if you want, I can tell you a list of 5 or 10 people that you can go research. Just feel free to contact me. Full disclosure, I also do this as well, so that is out there as well. All right, we have several questions over here in the sidebar that we could go through, but if somebody does want to speak up, please don't let me stop you. Feel free to speak up if you like. Otherwise, we'll go to the sidebar.
Yeah, Daniel, can I ask a question?
Yeah.
Larry,
but actually, let's ask the questions to the guest speaker while he's here, okay?
Okay.
Yeah. If you want to ask me a question, contact me offline.
Yeah, to the Larry, yes, yeah. Larry, with the COVID situation, what is your aspect of commercial real estate versus I think you spoke about the vacation, right? So what do you think different sectors of the real estate will do with the COVID?
Okay. Obviously, nobody has a crystal ball, and I think it's always dangerous to predict or to prognosticize. I think we're actually in better shape than we think we are, and I say that for a couple of reasons. The age-old adage that, look, they don't make more land. Our population for an industrialized country is growing at a pretty healthy clip, so the need for housing is always going to be there. The need for single-family homes is really strong and will continue to stay strong. I think COVID is only exacerbating the flight into the suburbs. We're seeing that. But long term, I think we'll also lick this COVID crisis. I think we'll probably have a vaccine. If not this winter, it'll be this spring or next summer. So things will get back to normal. I think if you just worry about that so much that you keep your powder dry, and if you have your emergency fund, but you're sitting on a couple $100,000 that you just don't know what to do with, don't be paralyzed by it. Put it to work. I really encourage you. I think you can't go wrong if you put it into an ETF or if you put it into real estate. And just long-term know that this will do fine. I'll give you an example. Jennifer and I bought these homes in Tahoe right before the financial crisis. But we didn't worry about it because we weren't over-leveraged and we knew the income. So as we saw, some of our homes went down by 50%, while others were panic selling and running away, ruining their credit. We just stuck in there, and 5-6 years later, they were back to where they were, but the entire time we were making money on it. So I generally tend to be positive, realistic, but I don't think don't let it paralyze you. First time real estate investors, oftentimes inaction is probably your worst enemy. I'll give you an example. A great pilot I flew with in Afghanistan was one of the best, right? So sharp, and he said, I want to get a place in Tahoe too and vacation rent it. And he did so much research on it and was so concerned about liability and lawsuits and LLCs and contacted lawyers. And literally every year I'd see him and I'd say, hey, did you buy that house yet? No, I'm still researching. He was one of those guys, was too bright, too smart, was paralyzed into action. So by the time Jen and I had 6 and they were all humming and throwing out cash like an ATM, he still hadn't gotten his first one because he was just overthinking it. Did I answer your question?
Yeah, thank you, Larry.
Hey, Larry, I see that if I did the return on investment for 33%, so you'll have a tax liability for 50,000, right? If you put in 100 and you get a 50% return, like you mentioned. So
yeah. Yes, you would. And all that would be spelled out in the K1, so it's not very convoluted to figure it out. I take mine to a tax preparer, but that's a K1 is going to cost you an extra $25, $50. It is, it would just be
I want you to talk more in the terms of a long-term rental versus a syndication. I see the quick money and I know the no headaches, but if you want cash flow over a period of time versus a syndication where you cash out every 2-3 years, is there anything else I should be aware of when taking long-term rentals versus syndication that you think matters?
Well, yes. So syndicate, none of these are liquid, right? So this is one of the shortest terms I've seen, the 24-month deal. Most syndicated real estate deals will say, hey, we're going to lock up for about 5 to 6 years. What they'll do is for example, a guy I invested in with Jennifer, we did buy multifamily homes, but they lock up your money. You give them $200,000 and they say, well, for 5 or 6 years, we're going to increase the rent on all of these multifamily units that we've bought. And then by the time we've cleaned up the units, polished them up, gotten so much rent, now we can sell a building instead of $5 million that we bought it for, we'll sell it for $8 million. And then everyone gets their return on equity plus the income they've made all along. So yes, that locks up your money. There's also opportunity zones. This stuff gets really complicated. That'll lock up your money for 10 years. But the same can be said for a long-term rental, because if you buy one and suddenly some family event happens where you need the money, it's also not a very liquid asset, because you may be forced to sell it at a time that isn't right. So all of this should always be considered on just long-term money that you are willing to just put away and then later come back to it when it's really grown.
Okay, but I can always do a cash out refi on my long term and get the money out and not have a tax implication, correct? Yeah.
Okay, so you're saying if you do a refi, take cash out and put it into an investment?
No, when you need the money, you say you don't have to sell the home in a long-term rental. If you've had it for 7 years or 8 years and you need money, you can do a cash out refi.
Oh, right. Yeah, no, sure. You could do that. Right. And that could be a worst case scenario too. The problem is it's, like I talked about, it's very tough locally to still find real pearls that return really good money. There's arguments to be made that where are we in the housing market? Are we in the 7th inning? We can't possibly go that much higher, because at some point the interest rates cannot go negative. So at some point, single family homes consistently selling in the $1 million plus range for most people, it's just not going to be realistic. So the rental market, I think, will stay strong. But if the equity isn't there anymore, buying in a local area like California, it doesn't make that much sense.
Hi, Larry. I have a question for you.
Yeah.
How many of these have you done, and how often have they not received their projected ROI?
So I've done 6, no, I've never lost any money. There's one thing as a pilot, you learn to be risk averse. You plan for everything from the time you take off. You always are prepared for an emergency divert. I would never put our money into something that I felt like is going to collapse. And what you do on these is you obviously study, hey, who's the sponsor? How many projects have you done? And on that slide deck on like page 17, there was an Excel spreadsheet of all his projects and like the last 30 projects, and nothing has ever come in negative. So they've always made money because these guys, most really good sponsors are going to have been in the game long enough that they have their construction guys lined up. These guys, it's part of their team, and their entitlement people and their architects and legal and their permits. They won't throw any money into something until it's ready, to grade and start to production. So, but the answer is no. I haven't lost anything on these. And
thank you.
Larry, I have a quick question on crowdsourcing real estate investment. Some of these companies like peerstreet.com. Have you ever looked at those?
No, I'm not familiar. So the ones I haven't gone to seek them out. I've generally just gotten more information from guys that pitched to the private equity guys. No, I mean, if you look at a couple different private equity offerings and you lay them side by side, it boils down to, hey, what do you like? What are the terms? How long will the money be locked up? What are they offering in terms of preferred return? And then I would also just obviously talk to them and get a feel and say, hey, what are these guys like? Possibly look at the project. You gotta follow your gut besides doing your research. So I can't give you more info. Daniel, if you could put up my last little PowerPoint slide, it just has my email and phone number. And any of you, please, if you have a question about any of this stuff, if I have the answer, I'll be happy to share it and just give you my unbiased opinion on it. I love helping people out on this stuff because it's really, really exciting. And for a lot of you, if you can start this stuff early and you learn from guys that have done stuff, like Daniel is such a great resource too, because he's dealt with all the headaches and he's seen all three of these options. And so I'm kind of just really mirroring what he's already said. So there's my email address and my phone number. Text me. Call me if you have any questions.
Only way to find out the information about these investors, like how many investments they have done, is asking through them only, right?
Yeah, but I mean, for this deal, for example, I can send you this PDF, and on page 17, you'll see their performance in past deals. So you can look at it and be like, okay, I see these guys made money on this one, this one, this one, this one. They're good. They bought their land years ago, and they baked the land to the point where now they knew, hey, this market is really hot now. So they've done their research. I like them because I personally met them. So it's a really solid outfit. There's 2 or 3 others I can recommend. But yeah, just send me a text, and I'll be happy to chat with you because this is stuff you want to take your time on and be really diligent on.
Hey, Larry, there are quite a few good questions in the chat, and what I'm going to do is I'm going to email them to you, and I'm also going to share them on our Yammer group. So I don't want to give them short thrift, and there's a lot of questions that are worth answering there. So I'll make sure that we do that, and just that we connect the people that ask the questions to you, and also share them with the group. So and thank you for the kind words. You don't thank you very much for being on. We'll go to questions that people have here. There have been a couple in vacation rentals as well. Such as picking a location, and how did you get 4.5% on your long-term rentals? And then one other good question, let me throw that out here, is somebody was asking, has anybody ever sued the investors in one of your syndication deals, and what has happened in that case? But there's a lot of good questions, and I will email them out to you.
Perfect, yeah. Let me leave you guys with one other thing. So I also, didn't jump into this, not doing any research. Vacation rentals, I met with an attorney in Reno, and I said, hey, should I put each of these into LLCs and protect myself? And I started getting this convoluted theory, and he laughed. He says, listen, you talk to any attorneys, they will tell you there's 3 people that sue each other. And they're almost always people that have had long-term relationships. I'll let you guys guess. A husband has an affair. He's been married for 25 years. That wife, rightly so, is going to be furious and will go after him. Okay, that's number 1. Number 2, employee has worked for a company for 30 years, and they've given their all, and now they're cut. Well, that's a lawsuit right there. It's a long-term relationship. He says on vacation rentals, he has never seen a lawsuit. I think Airbnb has literally had like 2 or 3 major lawsuits. It's out of, we look at their transactions, millions upon millions. It rarely happens because it's a short-term relationship. Even if people had a horrible time, by Monday they're back at work, they've forgotten all about Tahoe. Don't overthink it. I personally just get the highest liability I can get, which is usually $1 million in the property insurance, and then I do an umbrella policy, like $5 million on top of all that. So, the lawyer said if you're that worried and losing sleep over it, let's say 2 or 3 people fall out of the balcony and die, and they prove that you knew the balcony was bad, and they come after you, each one of those will settle for $2 million. Chances are you'll be fine. That's all I can tell you. Don't let it paralyze you. Just do your homework and get good insurance. Anyone else?
Can I? Hey, Larry. I have a question. Can you hear me?
Go ahead.
Can you hear me?
Yes, we can hear you.
Okay. So I was curious about. I know you can do like home equity lines of credit on like rentals and things like that. I was curious to know if there are products like that for the equity that you gain in the like long-term or the syndications that you know of.
No, I don't. In terms of, certainly you could take whatever home equity you wanted to take out of a house and then put into syndication. But I don't think the reverse way. The syndication has value. Yes, there's companies. Let's say you have something happens. You have $100,000 or $200,000 locked up in a syndication that's not. They're not looking to dispose of the assets for another couple of years, and you need that money. Oh, there's companies that'll buy your share for you. You're going to take a hit because they're bargain hunters. Like I said before, whenever I hear people talking too much about leverage, I generally don't like leverage because I think it gets people in trouble. I always say, I'm also old school. I always paid my homes off way early. I always did 15-year loans and then paid them off in 8 years because I couldn't stand enriching the bank. But that's me. I was a strange kid. Grew up in Switzerland.
Daniel, just a follow-up on that last note. This is Manas. So it looks to me that for long-term rentals, you can have a mortgage, put 20%, 30% down, whatever you can afford, and have a rental income, and then do your math if how close mortgage is to your rental income. But in syndication, it looks to me that everything is going to be cash only. Is it correct understanding?
Are you asking me or the guest speaker, or Larry?
Daniel, I think you'll agree. I don't think, no, you'll never be able to get a loan based on, hey, I'm putting it into this. Underwriters are going to give you a loan for real estate, but not for syndication investments.
Well, and let me clarify that a little bit. The sponsors of the deal, the general partnership, they're the ones that are raising the money. They're only raising for the down payment. They're getting a commercial loan and borrowing the rest of it. So your investment return is based on a levered return where there is a mortgage on the property or debt service on the property.
Okay, thank you.
Just a quick question. So you mentioned that you like to pay off your mortgage. So is that a good idea, or should you take that money and invest somewhere else?
Okay, great question. Yes, you hear this all the time. People would always tell me, "Are you crazy paying this stuff off early at 4 and 5%?" That's what it was, I guess, back then, and especially lower today. Oh, yes, it does sound crazy, but it makes sense because you don't know what your returns on other investments are, and you just know one thing: that bank is making money on you. There's a reason they are the biggest buildings in every city. They consistently make money as long as we owe them money. So I'm a huge proponent of just trying to get rid of debt aggressively. And that's, it's unusual to hear these days. But I see so many people preying on debt and coming up with the most convoluted, creative ways to finance more and more. And I think it's dangerous. It'll get us in trouble.
I just want to cut in here and say that it is 1 o'clock, and I wanted to thank Larry very much for coming in here and sharing with him. He's a great person to listen to, and so we'll have the video of this posted on our internal social media site and links to all his contact information. Larry, thank you.
Thanks, you guys. Good luck, everyone.
Thank you. Bye.
Yeah, thank you.
And Larry, if there's anything I can do to follow up with you, just let me know.
Perfect. Yeah, Daniel.
I'll send all the questions to you.
Perfect. And that'll have the contacts, and I'll email them all back.
Okay, great. We'll also post them on our Yammer group so that people can discuss them internally. Unfortunately, the social media for our team here is all Intel internal, and so it's difficult to share with the external speaker, but Intel HR does require us to keep it all internal.
Okay.
But if anybody's specifically reaching out to you, I will take that and I'll forward it to you.
Okay, perfect. And so what you're going to send me, I can answer via Jennifer's email, or how will I do that?
I'll just send you the questions, and you can either send them directly to the people, or if you like to share the answer with the entire group, send it to me, and I'll post it for the entire group.
Okay, perfect.
And I'll also go ahead.
Daniel, how do we get the link for the Yammer group?
I will send it to you. And in fact,
okay.
It should be in every single meeting invite that we send out. So look.
Is that the social media group within Intel that's the same as Yammer group, or?
Yeah. Here. Let me drop it in really quickly for you. Yammer.intel.com. Oh my goodness, people have joined the group. Okay, I'll go through and approve you. So just a moment, I'm grabbing the URL here. I believe this is the URL. And
I think Larry already left. I was going to say thanks to him. So.
Oh, I'm still here. Thanks, you guys.
Thank you,
Yeah.
Larry.
Great questions.
Thanks, Larry. Thanks, Daniel. Bye.
Thank you.
Thank you, Daniel. I got the link. Thanks.
Okay, Daniel, thank you very much.
All right, we'll sign it off. Thank you very much, Larry, and
Thank you, guys.
I'll follow up with you afterwards.
Thank you.
Thank you.
Okay.